There's a quiet war being fought right now, and almost nobody is watching it happen. It doesn't involve soldiers or borders or anything you'd see on the evening news. It's a war over a single question, the oldest, strangest question in human history. What is money, and who gets to decide what it's worth? For nearly 80 years, the answer to that question has been surprisingly simple. The United States decides. The dollar is the water the entire global economy swims in. But every so often, a piece of data comes out that makes you wonder if that water level is starting to drop. And a piece of data just came out that made me stop scrolling and read it 3 times to make sure I was seeing it right. China's holdings of US government debt, US Treasury securities, have fallen to their lowest level since 2008. 2008, the year the last financial crisis nearly took the whole system down. For years, the story of the world economy could be told in one sentence: America borrows and China lends. China took the dollars it earned selling us everything from phones to furniture, and it parked those dollars right back into American government bonds. It was the most important financial relationship on the planet, and it was so stable it became invisible. We stopped thinking about it. And now, slowly, quietly, without a single dramatic headline, that relationship is unwinding. So here's what I want to do in the next 20-something minutes. I want to walk you through exactly what happened, what it actually means. Not the scary version, not the cheerleading version, but the honest, boring, mechanical version. And why some very serious people in finance are paying very close attention to a number that most of us never even knew existed. And I'll say this right up front, so we're clear from the start. This is macro and geopolitical analysis. It is me trying to help you understand a moving piece of the global system. It is not personalized financial advice, and I'm not going to tell you what to buy or sell, because honestly, the interesting part isn't a portfolio tip. The interesting part is understanding the machine itself, because once you see how this machine works, you can't unsee it, and you'll start noticing it everywhere. Let me back up and tell you why this caught my eye in the first place, because I almost scrolled right past it. I was reading through a long, dry economic report, the kind with 100 footnotes and tables that make your eyes glaze over, and buried in there was this trend line showing foreign ownership of American debt over time, and China's line, which for a decade or so was this big, fat, dominant curve, has been sloping downward for years now, bit by bit, month by month, not a crash, not a fire sale, a steady, deliberate-looking decline. And it just kept going until it touched a level we haven't seen since the year the mortgage market blew up. And I sat there thinking, okay, why? Why would the country that has been America's biggest creditor for most of my adult life be quietly stepping back from the single safest, most liquid asset on earth? Because that's what a US Treasury bond is supposed to be. It's the thing you buy when you want to sleep at night. It's the financial equivalent of bedrock. So to understand why this matters, we have to understand what a Treasury bond actually is. And I promise to keep this simple, because the whole value of this is making a genuinely complicated thing click. In plain terms, when the US government spends more than it takes in, which it does constantly by trillions, it has to make up the difference. It doesn't just print the money out of thin air like people sometimes imagine. It borrows. And the way it borrows is by selling IOUs. Those IOUs are Treasury securities. You give the US government your money today, and it promises to pay you back later with a little interest on top. That's it. That's the whole thing. It's a loan dressed up in a suit. Now here's the part that makes it so important. Because America is seen as the safest borrower in the world, everybody wants to hold these IOUs. Pension funds, insurance companies, your bank, foreign governments. And for a long time, one of the biggest buyers in that entire crowd was China. Picture it like this. Imagine 2 neighbors. One neighbor, let's call him America, is the guy who spends big. Nice house, nice car, always upgrading. The other neighbor, China, runs a tight little business, sells a lot, saves a lot, and ends up with a giant pile of cash. And every year, America says, "Hey, can I borrow some of that pile?" And China says, "Sure, but you'll pay me back with interest." So China's savings flow straight into America's spending. America gets to keep spending without the cost of borrowing going through the roof. China gets a safe place to store its enormous savings and earn a steady return. For years, both sides were happy. It was a handshake that held up the roof over the entire global economy. But here's the thing about that handshake. It only works as long as China wants to keep holding those IOUs. And what the newest data is telling us is that China's grip on that pile of IOUs is loosening. It's holding less American debt than it has in roughly a decade and a half. And that raises a whole cascade of questions that we're going to unpack, because there are actually several very different explanations for why this could be happening, and they don't all lead to the scary conclusion. Some of them are pretty mundane, some of them are strategic, and one of them, if it's true, is genuinely one of the biggest slow-motion shifts in the modern financial world. So before we get to the frightening interpretation, the one that involves the future of the dollar itself, I want to be fair and lay out the boring possibilities first, because that's where the honesty lives. And the first thing you have to understand is that when China's holdings go down, it doesn't automatically mean what you think it means. Let me explain what I mean by that, because this trips up almost everyone the first time they see the numbers. When you read a headline that says, "China's Treasury holdings fell to the lowest level since 2008, your brain naturally fills in a story. It pictures Chinese officials in a room, deciding to sell, hitting a button, dumping American debt onto the market in a deliberate act of financial warfare. And sometimes, maybe that's part of it. But most of the time, the number moves for reasons that have nothing to do with anyone deciding anything at all. Here's the first boring reason, and it's the most important one to sit with. Treasuries have a price, and that price goes up and down every single day, just like a stock. When interest rates rise, and over the last couple of years, rates have risen a lot, faster than almost anyone expected, the market value of the bonds you already own goes down. Think about it in plain terms. Say you're holding a bond that pays you 2% a year. Then the government starts issuing brand new bonds that pay 4%. Nobody wants your old 2% bond anymore, not at full price, because they can just buy the new one and earn double. So if you wanted to sell yours, you'd have to sell it at a discount. Your bond is worth less on paper, even though you didn't sell a single thing. You just sat there. The world moved around you. So when the data agency tallies up how much Chinese-held treasury debt is worth, a big chunk of that decline can just be this. The bonds China owns became less valuable because rates went up, not because China sold them. On paper, the pile shrank. In reality, China might be holding almost exactly what it held before. This is called a valuation effect, and it's the single most misunderstood thing in this entire conversation. Analysts who actually track this stuff carefully will tell you that in some months the "China is dumping" headline was almost entirely a rate-driven mirage. The pile didn't get smaller, the measuring stick got longer. Now, the second boring reason. Even when China genuinely is reducing its holdings, it might not be selling in the aggressive way the word dumping implies. It might just be letting bonds mature and not fully replacing them. Remember, a treasury is a loan with an end date. Some last 3 months, some last 30 years. When one comes due, the government pays China back the full amount, and China has a choice. Take that cash and buy a fresh new bond, or take the cash and do something else. If China simply chooses not to roll every single maturing bond back into a new one, its total holdings drift downward over time. No dramatic sell order, no button, just a quiet decision made over and over to let a little bit of the pile run off. That looks very different from panic selling on an open market, and it moves prices far more gently. And there's a third reason that's genuinely sneaky, and this one I find fascinating. China may not be reducing its exposure to American debt at all. It may just be hiding it better. Here's how that works. When China buys treasuries directly, through its own accounts, that shows up in the official US data with a little Chinese flag on it, everyone can see it. But if China routes its purchases through a third country, say through a custodian in Belgium or through accounts in Luxembourg or the UK, the bonds get counted under that country's name instead. The money is still Chinese, the strategy is still Chinese. But on the public scoreboard, it looks like tiny Belgium suddenly developed an enormous appetite for American debt, and that is exactly what analysts have noticed over the years. Holdings in a handful of these financial way stations ballooning at suspicious moments, right as China's own reported number slipped. Now, I want to be careful here because this is the part where fact turns into estimate. Nobody can prove precisely how much Chinese money is flowing through those channels. It's inferred, not confirmed. But the pattern is real enough that serious people take it seriously, and it means the official lowest since 2008 figure might overstate the true retreat. China could be walking out the front door while quietly slipping back in through the side. So already, before we've even reached the dramatic interpretation, we've got three completely non-scary explanations. Prices fell, so the pile shrank on paper. Bonds matured and weren't all replaced, so the pile drifted down gently. And some of the money simply got rerouted through other countries, so it vanished from China's line in the ledger without vanishing from the world. If all three of those were the whole story, this would be a footnote, not a headline. You'd close the tab and get on with your day. But here's why you shouldn't close the tab. Because underneath those boring explanations, there is a fourth one. And the fourth one is the reason this story keeps coming back year after year, refusing to die. The fourth explanation is that China is deliberately, strategically, patiently reducing its dependence on the American financial system. Not because it needs the cash, not because rates moved, but because it has decided at the highest levels that holding the other side's debt is a vulnerability it no longer wants to carry. And if that's what's happening, then the falling number isn't noise, it's a signal. It's the visible edge of a decision that took years to make and will take years to play out. A decision about who America gets to borrow from and on what terms, and what happens to the dollar when its single largest foreign creditor slowly, deliberately steps back from the table. And to understand why China might actually want to do that, why it would walk away from the safest, most liquid asset on Earth, we have to talk about something that happened not in China, but in a series of meetings between Western governments, and something that a lot of countries around the world watched very, very closely. Because the moment that changed how China thinks about American debt wasn't an economic moment at all. It was a political one. And it happened in the spring of 2022, when a war broke out on the far side of Europe, and the West responded with something the financial world had never quite seen at that scale before. Overnight, roughly $300 billion of another major central bank's reserves, money held in dollars and euros, parked in Western institutions, considered untouchable, were simply frozen, locked, rendered unusable with the stroke of a pen. One day, those reserves were a sovereign nation's rainy day fund. The next day they were, functionally, gone. Not seized, not spent, but immobilized. And the entire world took a very careful note of what that meant. Now, whatever you think of the politics of that decision, and reasonable people argue about it fiercely, I want you to set that aside for a second and think about it purely mechanically, the way a central banker in Beijing would have thought about it. For decades, the whole appeal of holding US treasuries was that they were the definition of safe. Safe from default, safe from inflation eating you alive, safe because the American government has never missed a payment on this debt. But there was always a quieter assumption baked underneath all of that, an assumption so obvious nobody ever said it out loud. The assumption was that the money would still be yours, that you could actually get to it. That safe meant not just they'll pay you back, but you'll be allowed to collect. And in the spring of 2022, that quiet assumption stopped being automatic. Suddenly the world had a live demonstration that reserves held inside the Western system could be switched off if you ended up on the wrong side of a geopolitical fight. In simple terms, the lesson wasn't the bonds are worthless. The bonds were still worth exactly what they said on the tin. The lesson was scarier than that. The lesson was, they're only worth that if the people who control the plumbing decide to let you have it. Now put yourself in China's position, hearing that lesson. China held the largest or second largest pile of foreign-owned American debt on the planet. Its relationship with Washington is, to put it gently, complicated, and getting more complicated by the year. Taiwan sits there like an unlit fuse. Trade tensions come and go like weather. And here is a real-world example, playing out on the news in real time, of what the West is willing to do to a rival's reserves when the geopolitics turns hot enough. If you're sitting on more than $1 trillion of the other side's IOUs and you've just watched the other side prove it can freeze that kind of asset, what do you feel in the pit of your stomach? You feel exposed. You feel like you're holding a hostage that could, at any moment, become a hostage taken from you. And so the calculation shifts. It stops being purely about yield, about how much interest you earn. It becomes about something older and more primal, control, whose hand is on the switch. And once a country starts thinking that way, the slow, undramatic drift downward in its Treasury holdings starts to look a lot less like a bond portfolio doing bond portfolio things, and a lot more like a nation quietly reducing its exposure to a weapon that could someday be pointed at it. This is the reframe. This is where the boring explanations and the dramatic explanation finally meet. Remember the 3 innocent reasons the number fell. Prices dropped, bonds matured, money got rerouted. None of those are wrong. All of them are probably happening. But sitting underneath all of them is a change in intent. Because you can let bonds mature and choose to replace them, plenty of countries do exactly that, rolling their holdings over year after year on autopilot. The question isn't whether the bonds mature. Bonds always mature. The question is what you do next. Do you buy new ones and keep the pile roughly level? Or do you let it drift down, quarter after quarter, and put your money somewhere else? And what the data over the last few years increasingly suggests is that China is choosing again and again at the margin not to fully replace what rolls off. That's not an accident of the calendar. That's a policy. And here's the piece that makes analysts sit up straight, the part I promised you was coming, the part where you stop looking at the money leaving and start looking at where it's going instead. Because if a country is stepping back from American debt as a matter of strategy, it can't just let that money sit in a vault as cash. Cash is also somebody else's liability. Cash held in the Western system is exposed to the exact same switch that just got flipped on those frozen reserves. So the strategic move isn't just to sell treasuries. The strategic move is to sell treasuries and buy the one asset on earth that nobody can freeze, nobody can default on, and nobody has to give you permission to hold. An asset that doesn't live inside anybody else's financial plumbing. An asset that has meant money to human beings for 4,000 years, long before there was a dollar, long before there was a treasury, long before there was an America. I'm talking, of course, about gold, and this is where the story stops being about a boring line on a foreign holdings report and starts being about something that has been quietly, methodically unfolding in central bank vaults all over the world. Because at almost exactly the same time, China's treasury holdings have been drifting down to their lowest level since 2008, its official gold reserves have been doing the opposite. Climbing, month after month, ton after ton, in a pattern so steady and so deliberate that it stopped looking like ordinary reserve management a long time ago. And when you put those two lines on the same chart, the debt going down, the gold going up, you start to see the shape of something that isn't panic and isn't an accident. It's a plan, and the size of that plan, once you actually add up the numbers, is where this story goes from interesting to genuinely difficult to look away from. And here's where I have to slow you down and be scrupulously honest, because this is exactly the spot where a story like this can tip from analysis into fear farming. The gold buying is real. China's central bank has been reporting steady additions to its official reserves, and it's been doing it for a long enough stretch and quietly enough that it clearly reflects a decision, not a whim. That much is confirmed fact. But you'll hear people go a step further and say the real number is far bigger than the official one, that the true stockpile might be several times what's on paper, hidden through state entities and quiet purchases that never show up in the reported total. And I want to be very clear with you, that is an estimate. It's a plausible one, made by serious people, but it is not a known quantity. Nobody outside a small room in Beijing knows the real figure. So when you see a headline throwing around a number that sounds staggering, mentally file it in the informed guess column, not the fact column. The honest version of this story lives in the space between what's confirmed and what's inferred, and I'd rather you leave here knowing the difference than leave here scared by a number nobody can actually verify. But even sticking only to what's confirmed, the pattern is striking. You've got the largest holder of foreign currency reserves on the planet doing two things in tandem: gently reducing its exposure to the debt of one country and steadily increasing its holdings of the one asset that sits outside every country's control. And it's not alone. That's the part that turns this from a China story into a system story. Central banks around the world, not just China, but a whole cluster of them, have been buying gold at a pace we hadn't seen in generations. The freezing of those reserves a few years ago sent a message that every finance ministry on earth heard loud and clear, and a lot of them quietly drew the same conclusion. If it can happen to one country's reserves, it can happen to anyone's. And gold, sitting in your own vault, on your own soil, is the one form of savings that can't be switched off from a keyboard in another hemisphere. Now, the steelman, because you deserve it. Does any of this actually threaten the dollar? And the honest answer is, not quickly, and maybe not the way the dramatic version claims. The dollar is still, by an enormous margin, the world's reserve currency. The overwhelming majority of global trade, global debt, and global reserves still runs through it. There is no rival remotely close. The yuan isn't freely convertible. China keeps tight control over money moving in and out, and you cannot become the world's money while also refusing to let the world's money move freely through your borders. Gold can't run a modern trade system. You can't wire it. You can't settle a billion-dollar contract in bullion by Tuesday. So what we're really watching is not the dollar being replaced. It's the dollar's dominance being diversified away from, slowly, at the margins, by countries hedging a risk they now take seriously. That's a much smaller, much slower, much less cinematic story than the end of the dollar, and it's also the true one. So here's what this actually means for the system, and what I'd watch if I were you. And to be clear, this is macro and geopolitical analysis, not financial advice for your particular situation. Watch whether the next reports keep the trend going, or whether China quietly starts rolling its treasuries over again. Because a reversal would tell you this was tactical, not permanent. Watch whether other big holders keep drifting down alongside it, because a lone seller is a story and a crowd is a shift. Watch the gold buying pace, and watch whether more of global trade starts settling in currencies other than the dollar. Those are the tells, not the headline number, the direction of travel underneath it. Because in the end, the lowest level since 2008 isn't the story. It's a symptom. The real story is a slow, deliberate answer to a question a lot of countries started asking the day they realized their savings could be frozen. Whose money do you trust when trust itself becomes a weapon? China has been answering that question 1 quarter at a time in a language older than any currency, and the rest of the world is watching to see if the answer sticks. So I'll leave it with you. If you were running a country's reserves right now, and you just watched another nation's savings get frozen with the flip of a switch, would you keep lending to the same system, or would you start quietly buying the one thing nobody can turn off? Tell me in the comments where you land and why. I read them, and the sharpest disagreements are usually the most interesting. Thanks for spending this time with me. Take care of yourself, and I'll see you in the next one.